Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ulta Beauty Inc. Annual Report. Ulta Beauty Inc. offers a wide range of businesses and services through its various platforms. The company operates as a specialty beauty retailer, providing customers with access to branded and private label beauty products. These products include cosmetics, fragrance, haircare, skincare, bath and body products, professional hair products, and salon styling tools. In addition to selling beauty products, Ulta Beauty Inc. also provides various services at its stores. The company offers beauty services such as hair, makeup, brow, and skin services, allowing customers to experience the products firsthand with the help of trained professionals. This comprehensive approach enables Ulta Beauty Inc. to cater to a broad customer base, from those seeking specific product recommendations to those looking for personalized beauty experiences. The company's online presence is also significant, with its website and mobile applications providing customers with an additional platform to browse and purchase products. Furthermore, the company operates shop-in-shops within select retailers, expanding its reach beyond its own stores. Overall, Ulta Beauty Inc.'s diverse range of businesses and services has enabled it to establish itself as a leading player in the beauty industry. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be categorized into several key areas. One of the main drivers is the ability to offer a differentiated assortment of products that meet the evolving needs of customers. This includes having a convenient omnichannel footprint, best-in-class loyalty programs, and brand awareness through platforms such as Beauty Happens Here. Additionally, digital business growth, expansion of online order fulfillment capabilities, and increased speed of delivery are also significant drivers. Another important factor is the ability to partner with top brands, such as L'Oreal and Estée Lauder companies, which account for a substantial portion of total net sales. The growth of private label brands, such as Ulta Beauty Collection, and the expansion of e-commerce capabilities through platforms like UB Marketplace are also key drivers. On the other hand, revenue decline can be attributed to various factors. Seasonality, macroeconomic conditions, geopolitical events, tariffs, and trade restrictions can all impact sales. Additionally, consumer spending habits and confidence, competition from larger retailers, inventory management, and ability to gauge beauty trends can also contribute to a decline in revenue. Furthermore, the company's failure to adapt to changing technological environments, including emerging technologies like AI and agentic commerce, can also lead to a decline in revenue. Effective vendor relationships, exclusive rights granted by brand partners, and successful translation of market trends into saleable product offerings are also crucial for maintaining revenue growth. Net income and profit margins. A changing landscape, the net income of the company underwent a significant decline in fiscal 2025 compared to previous years. The net income decreased by $47.6 million to $1.15 billion in fiscal 2025, down from $1.2 billion in fiscal 2024. This trend continued with a decrease of $89.9 million to $1.2 billion in fiscal 2024, compared to $1.3 billion in fiscal 2023. The profit margins also experienced fluctuations during this period. The gross profit margin increased from 38.8% to 39.1%, but the operating income margin decreased due to an increase in SG&A expenses and a decrease in gross profit margin. Furthermore, the net income and profit margins continued to decline in fiscal 2026. The reasons behind these changes are multifaceted. Macroeconomic conditions, including inflation and elevated interest rates, had a negative impact on profitability. Additionally, increased input costs, inflationary pressures, geopolitical events, reduced consumer spending habits, supply chain disruptions, and vendor access to capital and liquidity all contributed to the decline in net income and profit margins. The company's omnichannel retailing challenges, marketing and advertising program effectiveness, distribution and order fulfillment infrastructure capacity, and third-party vendors' overseas sourcing disruptions may have also impacted profit margins. Overall, the changing landscape of the market has had a significant impact on the company's financial performance. The company's operating cash flow has been inconsistent over the years. While there are instances of positive operating cash flow, such as in 2023 and 2024, where it was $1.3 billion and $1.4 billion respectively. Other years show a decline. For example, in fiscal year ended January 31, 2026, the total operating cash flow was only $146,619. This inconsistency raises concerns about the company's ability to generate consistent positive cash flows. However, it is worth noting that the company has reported generating positive operating cash flow in some years, which suggests that there are periods of strong financial performance. The fact that this is mentioned on page 52 as yes implies that the company does have the capability to produce positive cash flows, but it may not be a consistent trend. The company's debt level has undergone significant changes over the past year. As of January 31, 2026, the company had $62.3 million outstanding under its credit facilities, a substantial increase from $0 on February 1, 2025. This marked a shift in the company's financial position, with short-term debt increasing to $62,287 in 2026 compared to $0 in 2025. In terms of interest expenses, there has been a notable change over the past year. Interest expenses have increased significantly from fiscal 2024 to fiscal 2026, with net interest expenses rising from -$17.6 million in 2024 and -$15.1 million in 2025 to $1.8 million in 2026. This increase is attributed to variable interest rates, which have had a significant impact on the company's financials. Overall, both debt level and interest expenses have undergone substantial changes over the past year, reflecting shifts in the company's financial position. Management's outlook for the company is optimistic, driven by a strategy focused on operational excellence and an elevated go-to-market approach. The goal is to grow store footprint to over 18 freestanding stores, while developing a dynamic and agile supply chain that supports efficiency and fuels growth through investments in technology and partnerships. The company's competitive advantages lie in its ability to drive core business growth, scale new businesses, and align the foundation for future success. Management remains confident that their business model will drive market share gains in the U.S. beauty category over the long term. In terms of liquidity, management believes that primary sources will satisfy cash requirements both short-term and long-term, with plans to continue investing in key areas such as information technology systems, store expansion, new brand additions, and supply chain improvements. Capital expenditures are expected not to exceed $450 million in fiscal 2026, with a focus on returning value to shareholders through authorized share repurchase programs. Overall, management's strategy is centered around driving growth, improving operational efficiency, and investing in key areas to position the company for long-term success. The company's financial activities have been notable in two key areas. Firstly, the company has not paid dividends to its shareholders, indicating that it has chosen to retain profits within the business rather than distribute them to investors. On the other hand, the company has engaged in share buybacks, purchasing a significant number of shares from the market. Specifically, 341,707,000 shares were bought back at an approximate total value of $1,805,257,000. This move is likely aimed at reducing the outstanding share count and potentially boosting shareholder value through increased earnings per share. Concerns about inventory buildup or supply chain disruption are prevalent throughout various aspects of the business. One major concern is the potential for inventory buildup due to adverse economic conditions and uncertainty in forecasting future product demand trends, page 13. This can lead to excess inventory accumulation, which may result in forced markdowns or promotional sales to dispose of excess inventory, page 15. Furthermore, vendor consolidation in the beauty products industry could lead to a reduction in merchandise availability, while loss of key vendors or brand partners could have a material adverse effect on business, page 16. Disruptions in supply chain infrastructure could drastically reduce the ability to receive and process orders, and increased shipping and transportation costs due to inflationary pressures are also concerns, pages 17-18. Additionally, inventory shrink due to damage, theft, and other causes is a risk inherent in the retail business, which has adversely affected results of operations and financial condition in the past, page 20. The recent inventory increase of $212.9 million, 10.8%, from January 31, 2025 to February 1, 2026 also raises concerns about inventory management, page 41. Overall, these concerns highlight the potential risks associated with inventory buildup and supply chain disruption, which can have significant impacts on business operations and financial performance. That concludes the financial summary for Ulta Beauty Inc. Feel free to comment below, and I will be happy to answer them when possible.